Howdy, Jacob here. Today we're looking at the company Argan, company 18 of our generic screener in the construction and engineering industry, 850 million market cap on 438 million enterprise value. So their net debt is actually quite a bit negative, meaning that they have a bit more cash on hand than debt, which is great. Through its subsidiaries, they provide engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services. Do you want to look at their insider ownership quick? 7.5%, which is not terrible. So for smaller companies, I do like to see if they have skin in the game, just because, for bigger companies, it's management kind of runs through stuff pretty quick. You don't have a lot of founders necessarily as your CEOs due to the fact that it's an older company. I mean, this company was incorporated in 1961, so odds are their CEO isn't their founder, since that would mean that they have worked there for 63 years. But it is positive to see that the management and board has ownership, and quite a bit of it. 7% is a good amount. So that really just makes you more confident as a shareholder that they're going to make the right decision. Gross profit and operating margin both down quite a bit. So we see 22% to 14% on the gross margin side, and then operating margin 17% down to 6%. So I don't like that. I definitely prefer the margins increase greater than your revenue, and the reason is the company is just becoming a better company. It's becoming more efficient. They're finding better ways to do what they've done in the past, and here we see that revenue's actually gone up more than their earnings, which I just don't like. Dividend roughly the same. They've really increased it twice, but not a big deal. Return on invested capital is double digit though, so they are increasing their business, which is great for them. Their balance sheet shows 197 million cash on hand with 215 million short-term investments, and no short-term debt, no long-term debt. So we're definitely looking at a very safe company, which again we saw from this enterprise value being so much lower than market cap. Their cash flow is pretty solid, so capital expenditures are very low. Recently, quite a bit of reinvestment. Their dividend of 15 million on a 5-year average basis. I mean, you're looking at pretty volatile free cash flow here, but let's say maybe it's 75 or so. So you're looking at about 20% of your 5-year average free cash flow. That 15 million in aggregate dividend is about just under 2% yield. So pretty solid yield, still above the market. And buy back a little bit of shares. Share amount repurchased is greater than the stock-based compensation, so they are reducing total number of shares, and then a tiny bit on the acquisition side. So with them not having any debt, there's really 4 ways for them to use cash flow, and 2024 they used all of them. So let's start making some assumptions here. Revenue growth side, I mean, it's been kind of all over the place. So if we just do last 10 years, 573 million from 383, I think maybe 4% seems pretty reasonable to me. I think a 15 PE, maybe even 16 because they have no debt. So let's do relatively in line with the average market, just based on the fact that growth probably won't be as much as what the market will be in 7 years, but I do think that for them to have no debt, as much cash on hand as they have, I feel pretty comfortable with that terminal P. So then, free cash flow is so much higher. It's interesting. We'll do a pretty big range here. Maybe we'll do 8 and 12. And then for share change, 1% would be about 8 million. Offset stock-based compensation about 12. So that means about 20 million would be 2%. I think 20 million seems pretty reasonable to me. And then the dividend, let's keep that the same because that's what they really have only increased it twice. So let's keep that the same. So this is assuming that maybe about maybe about 20, well, let's say like 35% of their money is going towards share repurchases. We're saying about 25% to dividend. And then we are leaving a little bit of room for reinvestment and acquisition to get this type of growth for them. And I mean, interesting, not terribly far off. Drop of 38% to get the return we're looking for. So I do think this is a good company. I think that it's not as consistent as some other companies, but a couple things I like: them having no debt and as much cash on hand as they have is a super big positive. And then great production of free cash flow is a positive. Things I don't like, margins going down, is definitely something that's not super attractive to me. But anyways, I do hope you enjoy the video. Have a great rest of your day.